Imagine you're a genius. The single greatest market timer who ever lived. And over 20 years, you missed just 10 days. Only 10. Out of 5,000. That tiny mistake? It cost you more than half your money. Let me show you the numbers. I've watched investors try to outsmart the market for 50 years. Smart people. Disciplined people. People with spreadsheets and gut feelings and very good reasons. And here's what I've learned, almost none of them beat the person who simply did nothing. Today, I'm going to show you the actual data, real studies, real dollar figures on why timing the market fails. And the third reason is the one that quietly ruins even the professionals. Here's a number that should stop you cold. Ned Davis Research studied the S&P 500 from 2003 to 2022, 20 full years. If you put $10,000 in and just left it alone, it grew to about $64,800. But missed the 10 best days in those 20 years, just 10, and you ended with around $29,700. You cut your final wealth by more than half. By doing almost nothing wrong. And here's the cruel part. Those best days don't politely announce themselves. They cluster right next to the worst days. In that same study, 7 of the 10 best days happened within just 15 days of the 10 worst days. Think about what that means. The market crashes. You panic, you sell, you wait for things to calm down. And then the biggest rebound days happen while your money's sitting in cash. You miss the recovery because you ran from the storm. So when does the perfect time to sell arrive? It doesn't. And that's just the beginning. There's a number in this industry that almost nobody talks about. It's called the behavior gap. Over the long run, the S&P 500 has returned roughly 10% a year. That's the market's return. But the average investor? They've historically earned far less, closer to 6 or 7%. Year after year. Decade after decade. Where does that missing 3 or 4% go? It's not fees. It's not taxes. It's behavior. It's buying when everyone's excited and the market's high, and selling when everyone's terrified and the market's low. Timing. The exact opposite of what works. And over 30 years, that gap is staggering. Let me make it concrete. $100,000 compounding at 10% for 30 years becomes about $1.7 million. The same amount at 6.8%? Around $720,000. Same starting money. Same 30 years. A difference of nearly $1 million lost to the urge to time. So even the pros must beat this, right? They have the data, the tools, the discipline. Well, here's where it gets uncomfortable. Let me tell you about Peter Lynch. From 1977 to 1990, Lynch ran Fidelity's Magellan Fund. And he didn't just beat the market, he crushed it. Around 29% a year, for 13 years. The single greatest mutual fund run of that era. So his investors got rich, right? Here's the gut punch. Lynch himself later pointed out that the average investor in his fund actually lost money. How is that even possible? Timing. People poured money in after a great quarter, buying high. Then they yanked it out the moment the fund dipped, selling low. They had the greatest fund manager alive working for them, and they still managed to lose, because they couldn't sit still. The fund went up. The investors went down. That's the entire tragedy of market timing in one story. So why do smart people keep doing this? Because you're not fighting the market. You're fighting your own wiring. Your brain evolved to run from danger. When the market drops, every instinct screams sell, get to safety. And when everything's soaring, every instinct screams buy, don't miss out. Fear at the bottom. Greed at the top. It feels like good judgment. It's actually the perfect formula for buying high and selling low. Benjamin Graham gave us the perfect frame for this. He said to imagine the market as a man named Mr. Market, an emotional business partner who shows up every single day offering to buy or sell. Some days he's euphoric. Some days he's despairing. The mistake is letting his mood become your mood. The timer reacts to Mr. Market's moods. The investor just waits for the price to make sense and otherwise ignores him. One of these people sleeps well. The other checks their phone at 2 in the morning. So here's the one principle to carry with you. It's not about timing the market. It's about time in the market. The investor who stays seated through the crashes, the rebounds, the noise, beats the genius who tries to dance in and out. Almost every single time. The data doesn't whisper this. It shouts it. Your job isn't to predict the next move. Your job is to still be holding when the compounding does its quiet, magnificent work. So let me ask you, have you ever sold in a panic and watched the market roar back without you? Be honest. Tell me in the comments, we've all done it. And if this changed how you think about waiting versus reacting, hit subscribe. I make one of these every single day. Tomorrow, we're looking at the one number on a balance sheet that quietly separates great businesses from dying ones. Remember, this is educational content, not financial advice. Always do your own research. I'll see you tomorrow.